Hello traders, Victor from TRADEPRO Academy, and I hope everyone is doing well today. In today's video, what we're going to be talking about is trading Fed events using futures. Now, I'm going to show you guys how to actually trade Fed events using futures and what you need to know in these Fed events to actually stand a chance during these very, very volatile situations. Now, just like in 2022, in 2023, the Fed events are going to be very, very important, and they're going to move the market a lot realistically. Inflation is still high, and the Fed's number one objective is going to be taming inflation by changing monetary policy. Now, by the time you've seen this video, there's probably a lot of different Fed events that have gone by already. We've most recently had the semi-annual monetary report testimony by Jerome Powell. It was a two-day event, but we also have the FOMC meeting minutes, and we also have rate decisions in March, May, right? There's a lot of throughout the year that are going to shape up, and they're going to be very opportunistic. Now, these Fed events, understanding how the market actually moves based on market participant psychology, really help you understand where the opportunity lies in this. They're going to be very opportunistic, but they're not as black as white as XYZ happens and you should do this, right? They're interchangeable, and it really depends on what is expected and how the market's expected to move based on what is expected. So I'm going to talk a lot more about this, but first let's jump right into this intro. If you guys are excited about that, hit that like button, hit that subscribe button, and drop a comment down below. Do you normally trade Fed events? Because we do at TRADEPRO Academy in our live rooms. So if you want to see what that's all about, where we read the DOM with you actively and look for trade setups, come check us out at TradeProAcademy.com. But let's dive right into this intro and get started. The reality of Fed events is that you do have to be forward thinking like the market. Now, what does that mean, right? The market takes in information before it actually comes out and actually applies it to itself and changes its movement based on said information. So let's think of it in a more simplistic way. Realistically, before Fed events, nothing really happens, right? Market's fairly tame. You're seeing a compressive period. A compressive period means that the market's ranging, right? Generally ranging or just moving within a distribution block. It's not that volatile. Now, this is because there's no new information entering the market. When there's no new information entering the market, the supply and demand are relatively balanced, and you're going to be in a balanced market where you have peaks and troughs. But if you take a look at it from a wider perspective, it does generally range, and it looks fairly boring, right? Especially on futures. If you get a 10, 20 point range and it doesn't really go anywhere, you start to lose interest realistically. Now, from another perspective, when the Fed event does come out, right, what you do see is new information entering the market that you didn't know about before. The market did not know about said information before, and there's going to be an expansionary period. That means that whoever enjoys said new information, right, whether it's the buyer or the sell side, whether demand or supply expands, you're going to get an expansionary period where actually price escapes out of that compression based on the new information and runs in one direction or the other. Now, here is another part of this. When new information comes into the market, this isn't everlasting, right? The market is forward thinking, so the market accepts said new information, reacts based on said new information, and then what happens? Market returns or reverts into a balanced or a compressive state because there's no new information. The new information has been absorbed already, and now market has this new information. It's now old information, and you begin another compressive or range period where price is in balance. When price is in balance, it generally does revert to old balances, and you can get a turning point opportunity trade in that. So I'm going to talk exactly what I mean by that. So when we talk about markets and new information, it's not that new information enters the market every 5 minutes, every 2 minutes, like 50 times a day, right? That's what causes these expansionary moves. In reality, the majority of the movement is going to be in a compressive state rather than expansionary, meaning it's going to be range bound where no new news is actually entering the market. So when we think about these Fed events, that's how we should think about this market and think about these trades before you have compression and balance. Once the announcement comes out, you have a period of erratic movement where there's expansion. That expansion then reverts or turns into a compressive state wherever it may be, right? So wherever the balance is, price is going to want to look for that balance after that new information is absorbed. So another thing that we should mention is that Fed events, right, they're based on monetary policy. That's what the Fed does realistically. Monetary policy that shape up the economy and the market movement, right? The S&P is very, very closely tied to the American economy. So the monetary policy allows us to see whether money supply is tighter or looser. So higher rates generally means tighter, means that borrowing is going to be more expensive. It's going to be harder to borrow. There's going to be less investments or less of a want to invest. Now, a looser monetary policy where rates are going to be lower, right? Rate cuts, whatever, just keeping low rates is going to be more expansionary, meaning that you're going to have easier borrowing, right? There's going to be more borrowing. There's going to be more investment. There's going to be more money put into said economy. So if the current state is tight based on inflation, right? You want to see how these Fed events actually correspond to that expectation, right? Because if you have the expectation that things are going to be tighter, Jerome Powell is going to be more hawkish, if you will, then you're going to see potential downside in the market, right? If those expectations have been there for a while, that's not new news, right? If Jerome Powell shifts his thinking from dovish to hawkish, from dovish to hawkish, that's new news every time that makes a shift. So you have to be able to discern what is new news versus what is old news and relate that to what is expected in these reports. So again, it's not as black as and white. So for example, in the most recent monetary policy report, right, that Jerome Powell testified at 2 days, whatever it lasted, there was the expectation that Jerome Powell was going to be more hawkish. Why? Because we have to understand that this year, everything centers around inflation. So if we understand that everything centers around inflation, then we can pinpoint how the market might react based on what people say and how the other economic data comes out and relates to the monetary policy. What do I mean by this? So inflation needs to be subdued by the Fed. That is their number one goal. That's their number one priority. That's what they've been talking about for a while. Economic data recently has been good, right? So leading up into March, into that March testimony, economic data generally has been good, showing that there's strength in the economy. Now, Jerome Powell thinking, well, hey, inflation, we got to put that thing down. That means that higher rates, but higher rates, you can only do that in a strong economy. So now that the economic data is strong, the expectations are that Jerome Powell would be hawkish throughout these meetings because he sees that the economy can handle higher rates, and that's what's going to help inflation come down. So he took a more hawkish tone. So that generally pulls the market down. But remember, we talk about new information entering and then balance. When this happens, yes, the market may drop. However, if this is a drastic new piece of information that we weren't expecting or something out of left field, realistically, markets are going to revert back into balance and they're going to fade the original move. And that's a strategy that I'm going to be talking to you guys about on the computer. But first, I want to explain a few things. So the deviations from the expectation, if you understand generally what's going on, especially around this inflation theory, the deviations are usually going to be massive cataclysmic events that we don't see on a regular basis. So maybe Jerome, like COVID or whatever black swan event might have happened, where the Fed and Jerome Powell have to hike or have to cut really aggressively out of the blue, right? That might cut 75 basis points, 50 basis points out of the blue to help stimulate the economy because everything is going in the gutter. Whatever the case may be, these black swan events usually going to be cuts because, of course, things, if they drop and the economy falters, they're going to cut and they're going to want to expand it. But those events usually don't get faded and they do have an everlasting trend and expansionary period. So you do have to keep that in mind. Now, the strategy that I'm going to show you is going to be based on understanding that markets revert into balance after these news events, right? You go from compression to expansion back to reversion into balance, right? Or you're looking for a fade opportunity. That's a strategy that I'm going to be looking at because these are going to be events that are generally, they are high impact. However, they're not very lasting because this new information was somewhat expected and gets pumped into the market. So what I'm going to be showing you today is trading Fed events, understanding distribution theory and the DOM, and looking for inflection points that fade the original move. So let's go right behind the computer and I'll show you guys exactly what I mean. All right, so let's talk about this Federal Reserve trading strategy for 2023 pretty much. When you have a Fed event, now, like I said, we're going to be using the example of March 7th when the Fed event did come out. And what we had in that case was the expected hawkishness from Jerome Powell, which would pull markets lower. Now, this trading strategy is based on what the expectations of the market are and the severity of the original move. So this general strategy is a fade strategy, meaning that whatever trend happens to shape up from the Federal Reserve event, right, from Jerome Powell's event, whether it's down, my idea is to find an area where we can get a bounce that's usually 20 to 30 points of a relief rally. This premise of this strategy is you're looking for a stop hunt after the original move. There's going to be a point, if it's not a very drastic event, which usually is not, you're going to get capitulation of the traders that acted in that direction. When that capitulation happens, you're going to get a move in the opposite side, whether there's late shorts, late longs, whether there's profit taking or just general stops, you're going to see a reactive move. So my thought process, how can we find this? Now, you might be thinking, why the hell would I be fading this if I can just jump on the news? Because when the news happens, you have a split second to react, to decipher what's going on, and to get in. If you get in at market and you've already dropped 15 points, right, it's very, very difficult to get it in on the original move. You can wait for the impulse, but usually, remember, news events, what happens? Compression, there's no new information, right? New information enters the market. Price moves erratically after. Price has, again, no more new information, pulls back into balance. I want to find how price can pull back into a balanced area. That's my thought process. So we're looking at distribution blocks. If you want to know more about distribution blocks, you need to check out our prior volume profile videos. Go see how those work and how distribution theory works, because what's going on is price is starting somewhere here, right? Price starting up here, and we have the top of this distribution block. So my thought process is, well, the 23 region, we should hold it out to see if some buyers can manage to pull prices outside of that area, right? Can prices reject and stall from moving into the distribution block, right? So that's the thought process. If you move into the distribution block, you have this massive key area here that splits on this profile at the 13, right? If you accept into the distribution block, right, once you've accepted into it, the strategy could just be look for the rebound after the dip, because that's another part of the strategy. If you can't find an area where you can find the impulse from the rejection or the stop run or the covering, you can find the pullback where this trend will continue, right? Based on distribution. So it's going to be the 23. Regardless, we're going to be looking at the 23 and the 13s when we do this replay on the chart. So it's going to be very DOM based. So let's see what we got going on. The news is going to come out. You're going to see a large drop in the markets. So when it comes to the depth of market here, when we come into our levels, I'm going to be watching, because the price is going to drop realistically. When price drops into our level, what I want to do is notice if there are going to be stuck shorts at that 23, because that's going to get that impulsive move. Now, a stuck short will appear in the column right beside the blue column. So when we come into the 23, into this region, 22, 23, right, we're not going to be super exact. In this column beside the blue column, right, you want to see large orders stacking up and continuously increasing in size, 300, 400, right? And at one point, maybe like 1,000, they increase and they don't move, because it's based on reactivity. The DOM is based on reactivity, how market buyers and market sellers react with one another. So if we have, you can see there's also some resting limits there. If we have that situation where you get a lot of contracts flowing into the market and prices stay stagnant, all you need is a rebid, and this starts to qualify that you're going to see that sharp reversal, and you're going to see either profit taking or a large stop run from the late shorts that have accumulated. So a stuck short when you're trying to pick a bottom is exactly what you need to see. Now, a little spoiler in this situation, right? I did try the 22s, 23s because it was stalling, took a stop, but you'll see the real stuck traders, right? This is the 22s, 23s. You're going to see the real stuck traders closer to the 12s, and this is going to present that opportunity. So let's see how we can trade it. And remember, when we play on distributions, if we enter a distribution, we want to hold that distribution so the 22 region becomes a very strong area to see if those sellers can come through. So we're going to be looking for that inflection point. So let's see how this shapes up. All right, so here comes the news, right? Jerome Powell is coming on. You got blah blah blah, hawkish, hawkish, hawkish. It doesn't move that much necessarily, and we have to understand what the levels are that we want to trade at. So we're going to be looking at these regions. And I'm gonna be watching this down very carefully because what's going on is they continuously sell at market, right? They're getting big sell orders and price continues to drop. That's the reactivity that you get in the markets. So when you get big sellers and they continuously sell under them here at market on these middle columns, right? You got 300 sellers, 400 sellers, and they keep pushing prices lower. You're realistically going to get a move to the downside, right? There's no stuck shorts necessarily, right? They keep selling, selling, selling. Here they're starting to maybe potentially accumulate. Nothing crazy though. They just reoffered below that. Look at that 600, 600. They push lower and they sell under them. Again, that's going to be a possible scenario of those continued shorts, right? Right now, you got a couple of guys fighting here. There was a lot of sellers here, 1,000 that got kind of stuck at this 28. But I'm looking for that large inflection point. I'm not looking for a 4-point move. They didn't get that trapped, right? They just rebid right away. I want to see them get accumulated aggressively, get an aggressive rebound from the area, and then we can look for that region. So they continue to sell and market it under and under market. And we're looking for this 22 region, 22, 23. And what you're seeing right now is the accumulation of 500, 500, 1,000 sellers at these lows that were getting kind of stuck, right? Because you got a lot of sellers here. You got a nice buy stop move, right? This is the thought. This is the area where I'm thinking, you know what, like these shorts could be getting stuck and we could be looking for that actual move to the upswing, right? Then you see 800 sellers that come in, they slap them down at the 27s. But watch, there's a lot of shorts down here that aren't necessarily letting prices go lower. Right? Large shorts, large shorts. They're not sustaining. They continue to sell. Doesn't look that hot, right? You got a couple of 100, 300 shorts there. They accumulate. So you might maybe try something like this, for example, right? Because they're holding them. They're holding them. And you get like decent little rebids. You're getting some buyers that come in. They bid it up. You get some sellers that get stuck here, right? You have like 300s. It looks pretty good, right? It's nothing crazy. It's not a huge stuck short. Now, this is a learning lesson. When you have an event like this, you need to see a very, very, very large stuck short, meaning when you come into this area, right? When you come into this area like this and you have these large market sellers that come in, what you want to see is a combination of the bid and these actual market orders come in. So when the market orders trade maybe 300, 400, right? They keep adding into them. They keep adding on the bid side and they keep going in at market. Now, what has to happen is this should not move. This should stay stationary. That means it shouldn't downtick. Even if it gets to 1,000, right? Maybe 1,500 sellers, it should not be down ticking. You have to get a massive, massive stuck short and then a strong rebid in the blue side column with multiple 100 lots, 300, 400, 600, right? And identify where these guys come in, set those limits into those buyers, right? And then you can look for that extended move. So you want, in these events, in large events like these, you need massive, massive stuck traders to actually get a massive reversal, right? So the traders that are getting stuck at these areas, yeah, okay, it's at the start of a distribution block, but they're not necessarily that strong of stuck traders, and they're not that strong of buyers that are coming in either. So they have to rebid here, and what they're doing is they're actually selling lower. There is somewhat of a rebid. It's not very convincing, though. You just saw 400 at this 25 kind of crap out. You're building out a ledge here on the volume profile. This 26 is going to be a hard nut to crack. And look, over here, you have an imbalanced 1100 buy side, right? That came in. It's sticking out like a sore thumb. 600 buy side sticking out a little more, and they can't really press it up. So this is it, right? It wasn't that stuck of a short, and you're getting 700, 800, 400 buyers, and they keep getting reoffered by massive sellers. This is not our level, right? And we paid to learn that lesson. It looked okay, but it didn't look great. And I'm going to show you what a great stuck short in these Fed events looks like and how we could actually play that. So they're still reoffering pretty strong. There's no real stuck shorts. No one's getting stuck. Everyone's happily selling. Sixteens trading, continuous sell. I'm looking at these columns, right? You just have continuous sell going in at market sell here. Larger orders are pressing down. There's a attempted accumulation of some sellers here. This looks very interesting because at these 15s, right, you get 500, 600. It's a very balanced auction though, right? There's equal buyers here. There's not that many stuck shorts, but you're getting a decent size of actual sellers coming in and they're failing to break, right? So there's some decent selling that didn't really go crazy reoffer around the 15. So this is an interesting area for us, right? They keep doing it now at the 14s. They're balanced though. The thing is, the buyers and sellers are balanced. I want to see something very imbalanced where the sellers are just in shock. Still, right? You got a lot of sell side that came in here. And right there is what we're looking for, right? You'll notice here at this 12 half 621 trade sell side, you get an uptick and it stays. So watch these guys. Look, and they're adding market buys and they're rebidding on those market buys. So what had happened at those lows between 15s and 12s? I know it's a 3-point area, but you're getting continuous stuck shorts, right? That are accumulating. For the first time, you're getting a decent rebid on some larger stuck shorts that are actually holding their territory. And now watch this 14 here. 14 adds a really large bid. Should this bid trade, right, there's a pretty high likelihood it becomes a stuck short in this scenario. So is our stop protected? Yeah, we can move our stops like this and consolidate them as well. Let's see if we can actually pick up this long though. Because we've identified the area, you can see we've rebid really aggressively 8-9 points off of that area, right? 8-9 points off of that area. We've rebid that level based on a very interesting stuck short, right? A lot of shorts that were accumulated between 2 to 3 points where you finally got a strong rebid and rejection. So these are stuck shorts that we're looking at. They're not a massive imbalance, but it's a really good area and imbalance for us to find some kind of footing in this Fed event where you can get, right, the short covering in this case, right, and a little buy stop run to the upside. So let's see if price will fill this. The price fills, and they're refusing to trade into that 14 where you have a massive bid, meaning that they're going to go market sell if that area gets tagged, and they risk the chance of getting stuck with the remaining stuck shorts down at these lows. You can see now these 14s or so, they've accumulated 1400 versus 900, right? They're accumulating a lot of potential short interest over here without getting a reoffer, right? These massive shorts, what's happening to them is that they're actually getting rebid by large buyers. So let's see if we can continue this move. So one take profit is already out. We can cancel the remaining short positions here. The next take profit, realistically, we want it closer to this like 28 where you have this imbalance, and then so on the reversal into these like 33s, because if you move above the 33s, you're looking at this profile and it's very thin up until the 50. So it's going to be easy for price to pass through these areas realistically, so on and so forth, right? This is how we generally look for that reversal, because one, the downside and the selling starts to slow down. Two, you start noticing the stuck shorts, right? It could happen to the upside as well. Start noticing the stuck shorts. They keep reoffering, but prices can't go any lower. Then you start to see the buyers and you want to jump in where the buyers are at. So based on this, this is how I like to trade. This is my trading strategy for Fed events. I wait for the original move to kind of pace out, because realistically, the original move is very hard to catch. It can be erratic. It can be a little choppier. And I wait for that to die down. And I want to see if market participants start slowing down and actually rejecting the current move based on stuck traders on a DOM and naturally key volume profile areas. And this all comes from the concept and the thinking that markets move based on market participant psychology, where if no new information is added to the market, then you get an additional new piece of information. That new information, if it's not drastic, it eventually dies out and turns back into balance. So that's the general thought process that I have when it comes to finding Fed event strategies. So if you enjoyed this strategy, please drop a comment down below. There's more Fed events to come through the year of 2023. And the best part of that is that we trade these events live. So I'll read the DOM with you guys. I'll identify trade with you guys in a live trading environment. So if you guys want to learn more about that and find these opportunistic trades, check out TradeProAcademy.com in our futures room, and I'll see you guys there. Also, if you want to be able to read this stuff, learn the DOM, learn the volume profile, be able to do all this on your own with, obviously, our guidance. We do have a course at TradePro Academy, so I'll see you guys there. Like, comment, subscribe, and let's jump into our next video. I'll see you guys soon.